What's going on, everyone? Welcome back to the Capitalized Podcast. I'm Chris Casella here with Grant Smith. And as always, this episode is brought to you by our private lending company, Sharper Capital Partners. If you want to learn more about how Sharper Capital can help you build your real estate investing business, you can check us out at sharpercapital.com. It's been a little while since Grant and I have hopped on here together. And, we've spent a lot of time having guests on the show and really trying to do some community outreach and provide value from other people's experiences and perspectives. And the other day, Grant mentioned that it's been a while since we've chatted together. So we wanted to hop on here, and we still obviously want to provide as much value as possible. So one of our presentations that we put together for a local RIA event was titled The 4 Key Areas of Competitive Advantage, specifically in real estate. So we want to kind of go through some of those today. Really, we're going to talk about 3 out of the 4 because that's, I think, where we add the most value. And those areas are deals, construction, capital, and then management. So property management. Once you have enough units to make that jump to having property management as a part of your business plan, we don't have a ton of hands-on experience with the management part. So we're really going to focus on those first 3 today. Grant, you want to go ahead and get started?
Yeah. Thanks for the intro, Chris. So the first area of competitive advantage that we want to cover is deals. Specifically, there are really 4 ways that we see when we're working with real estate investors as to how they're getting their deals. And it speaks a lot to the profitability depending on which way they choose to source their deals. We'll just start out by saying that 90% of all the deals that we fund are off market. And I mean that it might even be higher than that, to be honest with you, but it's a very safe estimate for us to say that at least 90% of the deals that we're funding with our private / hard money lending company are deals that are being found off market by these real estate investors. So what are the 4 ways that these real estate investors are sourcing deals? Well, the first way, and arguably the best way, is direct to seller. And I think that pretty much all the other levels of sourcing deals are just going to be derivatives of being direct to seller. So in being direct to seller, we're really talking about real estate investors who have a marketing strategy, a way that they're getting in contact with owners of properties, and then making offers on those properties and getting them under contract, typically without the help of a wholesaler or real estate agent. They are, buyer, seller directly. And the benefits here are huge, right? You'll see typically the highest margin on deals when you're working with people who are finding properties off market. They're also going to have a lot of control over these deals because they can negotiate terms. They can really get creative when it comes to working with the seller and just focusing on solving their needs specifically, as opposed to having to consider what the other competitors or other people that might be bidding the property in the event of like a real estate listing or a wholesaler per se. And then there's also multiple exit strategies when you're direct to seller, right? So a lot of these real estate investors, they might potentially first go in thinking I can either wholesale the property, or I can fix it up and flip it, or I can fix it up and hold it onto it as a rental. So there's just a lot of strategies that people can employ, and those are just a couple of them, right? There's other creative strategies that we've seen other real estate investors employ, either through some of the wholesale deals that we've done or some of the deals that we funded. But there's challenges, obviously, to being direct to seller. And I know it's getting more and more competitive to find off-market deals. People who are in the wholesale space there's better information out there for them to operate. So it is time consuming, right? You're going to have to build a marketing strategy, work with those sellers. Oftentimes they are motivated, but perhaps not the most efficient or logical because there's a reason they're not selling on market. So, it can be very time consuming and kind of painful, right? To try to work through some of those deals. And in addition there, right, you're going to have a marketing strategy. So you might be sending direct mail, you might have cold callers, whatever it may be. It can be expensive, and the people who are doing it at a high level maybe they're doing pay per click or something to that effect. It does get expensive. So there are cons, obviously, to trying to go direct to seller, but the advantages are massive when you do find a business model that works and are able to get properties under contract at an economic price point. The next area that we see most of our deals coming through, and I would say, the bulk of the deals that we fund happen in level 1 and level 2 here. The second level being wholesalers. And wholesalers are a lot of the people that we're just talking to previously, right? We're talking about previously, right? These are wholesalers specialize in finding off-market properties, right? They specialize in getting direct to seller. But our real estate investors, oftentimes, are going to be strong in other areas of competitive advantage, which we'll cover in later slides. But they're sourcing the bulk of their deals from wholesalers, right? So again, these are typically off-market deals. This is kind of the marketing, and it's like the off-market deal sourcing done for you model. If private or hard money lending is the private capital raise done for your real estate investing business, wholesalers are the deal sourcing done for you, marketing strategy for your business. And the benefit is, really to get in with these wholesalers, it just takes building good rapport, making sure you do what you say you're going to do, moving quickly through the deals that they have, and getting a competitive offer in there as quickly as possible. And we'll say this from our experience of having wholesale properties and a separate entity ourselves, it doesn't always come down to price. So I think a lot of real estate investors kind of get hung up on that, thinking, well, I always need to have the highest price in order to win out with the wholesaler. But a lot of times wholesalers just want to work for a good price, but also are going to work with someone who's going to make it easy to close and easy for the transaction to go through. But you are going to have to pay for, the wholesalers doing this work for you, right? So you're going to have reduced margin because they're going to have an assignment fee. They're going to mark up the property, and it's non-exclusive, right? You don't have direct access to the seller. So you're going to lose out on control, or maybe some of that flexibility in negotiating, when closings take place, whether the tenants are in or out of the property at closing, things to that effect. So the next channel that we see our real estate investors getting deals through is agents. So I would say that this is probably one of the highest leverage activities, because all the properties that, get listed on the market, an agent's going to be able to help you get access to those properties as quickly as possible, right? They can set up filters, reports that get emailed to you, really as soon as a property gets listed on the market and fits your criteria for that search. So it's definitely better access than, you just going out, you as the real estate investor, just going out and searching for properties on Zillow or Redfin or wherever people commonly search for properties. And you're also going to have the expertise and professionalism of a good real estate agent, hopefully. And we can always make referrals for real estate agents. I know we just interviewed a couple of them, so there should be a repository, let alone on our podcast there. But obviously, with having more visibility, looking at properties that are more easily accessible to real estate investors, or just the public in general through the MLS, it's going to come with more competition. And I think that's just the truth of it. More visibility typically means more efficient pricing, which further means, higher prices and tougher to get the margin that real estate investors would typically need on a deal. And arguably, it's probably the least amount of control you're going to have over a deal, of the ways that we're kind of listing here, because a lot of times real estate agents will be negotiating against other real estate agents. So there isn't going to be the opportunity to really talk directly to the seller in this case. Again, it's going to be two professionals, not even you communicating directly to the seller's agent, but the buyer's agent who's representing you communicating with the seller's agent, which again, there's pros and cons to that. And I'm definitely not talking against it, but I will say that in general, when getting started investing in real estate, we we connected with really good real estate agents, and they provided tremendous value for not only our lending company, but for the first flip that Chris and I did, which, we talked about in a previous episode, and then other investments made thereafter. Real estate agents played a key role in helping us find and source those deals. So there's definitely a huge benefit to having great real estate agents in your corner. I would say like the lowest tier here for sourcing deals, right, is just on market and unrepresented, right? You're going to be looking at deals that you're not really going to get a whole lot of access to. If anything, you're going to be talking to the seller's agent, trying to get access to the property and not having the representation you need. And really the point we're trying to make here is on-market deals in general are not the way you want to go. If you're going to be working with an agent, typically you're going to be hoping for some pocket listings or other properties that, maybe haven't even hit the market yet. So in general, when you're looking for the most economic deals possible, you're going to want to try to find deals that are off market, either through agents, wholesalers, or in the best case scenario, direct to seller. Anything on market is probably going to produce the least profitable outcome for you in general. So I know I just rambled on about deals and sourcing deals right there, but I'm going to actually pass the ball back to Chris and check to see if I missed anything. And if not, then we can move on to the next section of what we're talking about here.
Yeah, thanks for covering all those. I think, it's easy to get overwhelmed with all the different ways that there are to source deals and then trying to think through, okay, well, what's the best option for me? And the truth is, you touched on this, Grant, direct to seller is definitely the highest margin activity, but it's definitely, it can be the lowest leverage in the sense that it takes a lot of work, it takes a lot of time, it costs a lot of money. And if you want to employ that strategy, you're going to turn on a bunch of marketing channels, and it's hard to just turn them off, right, on a monthly basis. So let's say you have a bunch of leads coming in because you've set up your platform and you've set up your business to go direct to seller. Well, then all of a sudden you get, 3 properties under contract and you want to flip them or you want to burr them. So you're going to have to renovate them and then refinance, or renovate them and then sell. So now all of a sudden you got to be managing a team who's doing the construction on the property. And you also have these channels that are spending money, and you want to be able to get to all the leads and the phone calls because you don't want to throw money away. But it's really hard to manage it. It can certainly be hard to manage it. And I've seen that with, a handful of people we work closely with where, it scales pretty quickly after you spend time building up a backlog and getting the channels in place. And it can be a lot to manage. So like you said, some people have competitive advantages in other areas. And so maybe it doesn't, they don't need to go direct to seller because they can make up for that additional margin in other ways. And similarly with wholesalers, I just wanted to say a quick note. I talked to Ethan Bishop yesterday on our podcast. It'll probably be aired by the time that this one comes out. But, we touched on this whole idea of how wholesalers have the typical margin on a wholesale deal has gone from like $10,000. Now it's like people want, 25, 30, 40, whatever it might be. It's definitely gone up. And I think the barrier to entry to wholesaling is very, very low. So that means a lot of people can enter the market and call themselves a quote unquote wholesaler. And they might not have a great deal or even know what they have, but they're marketing it. And so it's easy for wholesaling to get a bad reputation. But when you do get in with the good ones, it can be extremely valuable. So valuable that a lot of our clients who are direct to seller, who have their own marketing channels and systems in place, still buy deals from other wholesalers. And I think a lot of that is because they know what to look for, so they can spot a deal really quickly since they're used to it. But it's also because there are wholesalers out there who have great deals. And listen, maybe they know they have a great deal, or maybe they don't. And that's why you get in at a good price. But whatever the reason, the deals are definitely out there. We're closing, today's a Thursday. Tomorrow we're closing one with one of our existing clients, and he has a direct to seller marketing channel up and running, and it's very successful. And he's buying this deal that we're funding tomorrow from a wholesaler. So those are 2 great options. And where they fit into your business is something that we can maybe talk about a little bit later as we talk about these other 2 competitive advantages. But the last 2, Grant, that you touched on are agents and then on-market deals. So I just want to be very clear here. And when we say that 90% at least of our deals that we fund are off-market, that's because both direct-to-seller, wholesalers, and agents can all have deals that are off-market, right? A lot of real estate agents, especially the good ones who are hustling and have built great relationships. You mentioned pocket listings, Grant. Like, not all deals that come from agents are going to be just listed on the MLS that the agent came across just browsing in the morning. A lot of them are going to be ones that they're working hard to get. And then if you're a good client with them, they know that you're looking and they'll send it your way. So agents can be a really valuable resource for real estate investors. And we've seen it firsthand and secondhand with our clients as well. And then on market, listen, everybody has their own opinion about this. I think it depends on kind of what your strategy is, what your competitive advantages are. But we fund, we're closing one tomorrow, or we're funding one tomorrow. That was a deal we found on market that came through a relationship that we've been building over time. And that's going to be a great deal for our client. And we have a few in the pipeline that are on market, as well as some that we've recently funded that our clients were just browsing and were like, hey, I just flipped a property two blocks away. This one is in great condition, just needs a cosmetic facelift. And they put a competitive offer in and move very quickly. So I think there's ways to make the most of on-market deals. And in order to do that, you really have to know your stuff. You have to know the area very well, because when you see a deal, you gotta you got to move on it pretty quickly for the most part. But there's ways to win with all of these channels. And I think you laid it out really well, Grant. But I just want people to know that because there is a best way, I think, where there's the highest margin, but then there's also the best way for you individually as a real estate investor.
Totally agree with the points you made there. And again, I want to emphasize just the value that we've gotten from working with great real estate agents. I mean, it was essential for our success, especially early on with that first flip we did. And I mean, we utilize real estate agents for all of our broker price opinions and construction draw management today. So I think there's definitely a time and a place for agents. And I really like how you highlighted it's not about this is the one method you need to use in order to be successful in real estate. That's definitely not what we're saying. And I think something that I've noticed from the people who are getting just the most deals in general is they're finding deals all four of these ways. They have a strategy for communicating with a bunch of wholesalers, communicating with a bunch of wholesalers, communicating with a bunch of agents, in addition to their own marketing efforts off market. And I'm not sure what their methods are for finding properties through on-market strategies are, but I definitely know they utilize agents to get a lot of coverage. So again, really, really just highlighting that point that you made, Chris, because I do think it's really important. But
for sure, yeah. Sorry, just one last thing here because you made me think about it. The agents are so valuable, more so, and what you just touched on, Grant, is great because they're not just valuable for finding the deal. They're also valuable for so many other things, connecting you with a good title company, helping you find contractors, helping you understand whether or not a deal is a good deal or not, right? I mean, there's just so many different ways that an agent can be helpful because they typically are pretty well connected in the community, as well as the fact that they can probably help you list the property on the back end if you're going to flip it. And so, maybe if you're newer and kind of just starting out in real estate investing, I would almost say working with an agent would be your best bet because we just had Stacy Shelby and Ethan Bishop. They're both from the Chabris Group, and they're both incredible agents here in Cincinnati and amongst, many others like we work with like Rob Speckert, and there's way too many to name here. So if I'm leaving you out, please don't take that personally, but there's so many great agents and we've worked with them ourselves, like you touched on, Grant, but Stacy was talking about how she works with a bunch of first-time investors and she just lays out the process as crystal clear as she can and how she connects them and connects her clients with different vendors and resources in Cincy. So if you're just starting out in real estate, I think agents could potentially be the best way to go. And same thing if you are an out-of-state investor where you're investing, maybe it's quote unquote virtually, because for all the same reasons, really, you might know how to invest in real estate and you maybe even know the market well, but in order to get somebody trustworthy and make sure that you have somebody who's boots on the ground, who's vetting not only your deals, but also the other people you're working with, like contractors, et cetera, just invaluable because it can avoid so much disaster.
Couldn't agree more. Okay. Let's go ahead and move on to the next section here, Chris, and I'll let you run with it.
Awesome. So the second one that we want to talk about today is construction, right? So let's say you find the deal. All right, well, you're going to have to fix it up for the most part. If you're in real estate and you're employing the BRRRR strategy, or if you want to flip, a lot of the great deals come by forcing value, right? By forcing appreciation through construction, through rehab. So there's 4 levels here similar to finding deals off market or finding deals at all. There's 4 levels here that we really wanted to highlight. I'm going to read through them first so that you kind of know where this conversation is going to go. And then I'll dive into each one individually. So the first one is you have your own full-time crew, right? That's clearly going to be the way to make the most money and to have the most control over the construction process. The second one is self-managed. So that's where you don't have a GC and you're hiring subcontractors all on your own. You're going to save some money in that way, but it's not going to be as much control as having people that are dedicated to you. This third one is going to be materials management. And so in this case, you're also going to be buying your own materials, but you might have a GC who's doing the project, right? So maybe somebody is actually managing a lot of the contractors themselves, but then you're out there and you're paying for the material and you're either having it delivered to the property or you're having the GC pick it up, whatever it might be. And then the fourth one is just hands-off general contractor, wipe your plate clean, let them handle it, and you're going to pay a premium for that, but you're also going to get a lot of your time back. And if you're working with a good one, there's a ton of benefits. So let's go ahead and dive into each one of these individually. First and foremost, if you're working with your full-time crew, like we mentioned, that's definitely going to be the highest margin, right? Because you're not paying any sort of premium to hire this out. You're not paying any premium to have it managed for you. These guys and gals are going to be working maybe for a salary, or maybe they're working for an hourly wage. And so when you have different projects and different stuff that has to get done, you know what your costs are going to be, and you can allocate your resources in the form of labor accordingly. You also have a ton of control, right? So let's say you find a deal and you got a dedicated team. Well, you can have one of your team members go out there and check out the deal and let you know pretty quickly how much it's going to cost you. And you can know with a high degree of confidence whether or not that's going to be pretty accurate, right? Because you can run your numbers and say, hey, it's going to take this many men or women, and it's going to take, this much material. And I think that kind of goes along with the third point that we have written down here, which is speed, right? I mean, you can get people out there to look at properties quickly, but you can allocate your resources, again, in the form of labor anywhere you need to. So if you have a team that's dedicated to you, you don't have to wait to make sure that you can get them on your schedule. You can get them out there and you can say, hey, this is the property that we're going to prioritize, and we want to knock this out really, really quickly. And you have control over your own team. And so you can do that. The cons here, it's going to be time consuming because you're building a business essentially, right? I mean, if you have your own dedicated crew, you're managing a full-time team. So now you have employees. And of course that comes with a lot of time in order to manage people effectively, to make sure that, you're building a good culture, to make sure that people are getting paid on time. You have payroll set up. Maybe you have insurance, unless they're 1099. There's just a lot of different things to consider if you're hiring employees that you don't necessarily have to consider with these other strategies. It's pretty risky because you could also come to a point where you don't have any projects, but you're still paying people to be, full-time employees. We've seen that with, not a ton of our clients, but just in general, people are saying, oh, I got to buy a deal because I got to keep my people busy. And that might be because they're working with a general contractor that they want to make sure is, prioritizing them over other people. But a lot of times it's because they have people that they're paying no matter what, and they got to get them to work to make sure that they're getting a return on the money that they're paying them. And then there's some headaches, right? I mean, I kind of touched on this, but anytime you're managing people and you got a full-time team, there's just a lot more to consider than just strictly the business stuff, right? You're going to be managing personalities, you're going to be managing relationships, and a lot of that stuff can get tiring if you don't have all the right people, and sometimes even if you do. Second one here is self-managed. So again, just to reiterate, this is when you are hiring the subcontractors yourself, right? So you're going into a project, you're saying it's going to need all new mechanicals, it's going to need new flooring, it's going to need paint, you're going to have to put in a kitchen, and it's going to need maybe it needs a new roof. So all these things can potentially be subbed out to different contractors, especially if you're going to get the right price and get the right quality of work that you're looking for. This is going to be lower financial risk because you're not paying people full time, but you're going to have a less margin than a full-time crew. It's second on the list because it's going to be pretty much second in terms of how much control you have and how much margin you can gain, because you're going to save a lot of money by not hiring out the management of your construction. But it's obviously going to come with its own cons as well, in the sense that it's very, very time consuming, and there can potentially be a lot of headaches. I mean, if you think about the number of moving pieces you have when you're subcontracting out maybe 8 different trades, well, that can be very, very frustrating, because now you have to make sure people are showing up on time. You have to make sure that the work is getting done properly. And this is all just exponentially harder the more projects that you have, right? I mean, even 2 projects compared to 1, exponentially harder. When you talk about 3 projects compared to 2, again, exponentially more difficult. So all this is just magnified when you start to scale your business. But again, people do it very successfully, and it can be a really good way if you're kind of in between, maybe having your own full-time crew or maybe just hiring a GC can be a very good way to structure your business and make sure that you get a high degree of control, a high margin on your projects without taking that big step of having your own dedicated crew. Third one here is materials management. And again, just to make sure we're on the same page, this is basically hiring out a GC, but then purchasing your own materials. So you can definitely save money by doing this, because for anybody who might not know exactly how it works, when you hire a GC, they're going to mark up their labor, but they're also going to mark up their material, because there's a lot of time and energy spent for the GC on picking up the material, on purchasing it. It's, they got to make their money and they got to make a living somehow. So you can save some money here. Pretty, depending on the size of the project or what you're doing, maybe a pretty good amount of money. And in this case, it's a good way to be able to control your inputs. It takes a lot of work when you're working with a GC to make sure that they're getting all the right products that you want. And basically, not only to make sure that that's happening, but also to verify, right? To make sure on the project itself that they actually ordered what you wanted them to order. So you can control the inputs here if you're the one clicking on the website, which, and buying the materials that you want. And you can also make sure that you're buying materials that fit your budget. So this is a really good way to have a high degree of control over your materials. And it's going to be a little bit less time consuming than the two options that we had just talked about. It's not nearly as time consuming as having your own crew, and it's definitely not as time consuming as managing your own subcontractors, because really this is just going on. Maybe it's Home Depot, maybe it's Lowe's, maybe it's Floor & Decor, and picking out what materials you want and having them delivered, or having your GC pick them up. But there's going to be lower margin because you're working with a GC, and there's going to be less control over the labor itself, because again, you're working with a GC. So you're going to pay them a premium for managing the project for you. And then finally, general contractor. This is pretty self-explanatory. It's going to be the absolute least time consuming if you work with a good GC. And that's a huge, huge, huge asterisk, because if you don't work with a good GC, it's going to be time consuming, it's going to be expensive, and it's going to be headaches. It's going to be basically all the cons that we talked about. But that's true for any vendor that you work with. It's just especially true when the person that you're hiring is the one actually doing the work on your property. So least time consuming, which is a huge pro, especially maybe you have a W-2, maybe you're a business owner and you got other stuff going on. So it could potentially be worth it depending on what your situation is. And, I'll just say firsthand, like I'm working on a project right now in Covington, and I'm hiring a GC. I want them to take care of all of it. I got, we got some other businesses that we're working on, and I just don't feel like I have the time that would be necessary to do a good job managing the project myself. The cons, it's just going to be more expensive. You're going to pay for that time that you're getting back, and the lack of stress when you hire a good one to have them manage the subcontractors and handle everything. You're going to pay a premium for it. And then you're going to have the lowest degree of control, just meaning you're not going to have your hands directly involved in how everything is being done, right? You're outsourcing that to the GC themselves. So I just went through a lot there. Grant, what did I miss? What would you want to add to that? What are your thoughts here?
No, I thought you did a great job of consolidating a lot of information there. I think I like the example you gave of talking about how you're using a general contractor right now, because it kind of makes a point that I kind of had in the back of my mind all along. We've gone through two different subjects of competitive advantage in real estate investing. The first being sourcing off-market deals, or really finding deals, and then the second being construction. So we just kind of gave a tier of which are more likely to derive a higher margin on the projects you do. And I think it's very common that people who might be in the top level in one area of competitive advantage, they might be in category 4, of the other area. So an example would be you run a wholesale company and you're just great at sourcing off-market deals, but you spend so much time sourcing the off-market deals that you get them at great prices. So you can afford just to have a general contractor who's going to handle all the material, who's going to, run the project for you efficiently. You don't have to think about it. But at the same time, there's easy ways to employ these strategies in construction, just to a higher extent. And I think one of the easiest ways is just materials management. And Chris, I'm not sure if that's a strategy that you've employed on your project in Covington, but we see it all the time with our real estate investors. If a property has a garage on site, they'll order all of the material that the general contractor thinks they're going to need for the project. They'll order it directly and just have it shipped and delivered, and store it in the garage, and just make sure the garage is always locked so nothing gets taken. But points to that effect of there are ways to, hey, you might be in the highest level of competitive advantage in one category, But it doesn't necessarily mean that you have to be in the highest level of competitive advantage in all of them to make your specific deal work or your specific investment strategy work. Really, it's just about pointing out, hey, here are a few key ways to implement multiple levels of competitive advantage to derive the most profitability. And now that we're layering these two subjects on with one another, I think that's becoming more apparent. And I think you did a great job of explaining the construction piece here.
Thank you. Yeah, that's a great point, Grandon. The truth is, if you're employing the number one points of all three that we're about to talk about, I mean, at least in the first two, where we're talking about sourcing deals and then the construction piece, you're essentially running two businesses. And so that's obviously a really difficult thing to do. Some people do it, and we see it. We work with those people, and they do a great job. So it's absolutely possible. It's not to deter anybody from giving it a shot or employing that, but it's definitely difficult to do. And we see a ton of people having success, even if they're at level 2 or 3 in all the areas. You don't have to have this. I think clarifying that really when we're listing these out, we're measuring them by what's going to give you the highest margin to make the most money, because all of us here are investors, and I think that's a good way to measure it. So that's all I got for construction. If you want to move on to the third and final piece here, Grant.
Yeah. So the last piece that we're going to cover here is the area of competitive advantage surrounded in capital. So in capital, we broke it down to 4 sections again, but really there are a number of ways that you can source capital for your deals. Again, we're going to focus along the through line here, which has been making sure that we're talking about the capital sourcing or the competitive advantage that derives the highest margin. So in terms of what would be the most economic way to acquire a deal, fix it up, and either refinance it for rental cash flow or flip it. If you have your own cash, right, there's a significant advantage because number one, you have tremendous speed. You're able to close as quickly as title can move. You're not waiting on any third party to tell you that you're clear to close other than the title company, right? And you also have a ton of control over the deal because you have the capital sitting in your bank account, and the ball is in your court. And at the same time, when you have your own cash, you're not paying any sort of margin out to interest expense or anything to that effect that is going to reduce your cash flow or the overall profitability of your deal, because you're the one that's funding or financing the entire project. No, going to result in a lower return on investment, right? Because let's say you flip a property and expect to make a $50,000 profit, but it required you to put $200,000 of your own money into the deal to fund the entire thing, the purchase, all the closing costs and holding costs. Well, that's only going to be a 25% rate of return, as opposed to maybe you finance some of the deal or all the deal, and now you're able to get a $30,000 return, but maybe you don't have hardly any money into the deal. Maybe you only had to leave $30,000 in the deal to get that property done and fixed up. That'd be closer to 100% rate of return or 100% rate of return altogether. So leverage can do that, right? It can increase your rate of return, but it's not result in the highest dollar return. And the reason everyone's saying, well, of course, I'd love to go out and just fund all those with cash, but I don't have those. I don't have just money laying around. That's why I'm investing in trying to earn money on the money that I do have. So that's where we can talk about these next areas of capital sourcing, because they're the solution to the problem when you have more deals than you have capital. So the second tier to maintaining the highest profit margin and also probably maintaining the most flexibility on financing your deals and moving quickly is to source private capital. So what is private capital? I like to consider it the same way that wholesalers try to get directly to sellers, or like we talk about real estate investors can try directly with sellers. This is a method by which real estate investors are raising capital directly from people who have that capital. They're not going through a bank, which is sitting on a bunch of deposits and pulling that capital and lending it out once you reach a set of criteria, or even a hard money lending company, which works very much the same way. So private capital, right, is probably going to be the most affordable capital raise option that you have. And the reason I say that is because everyone else who is in the business of providing financing to real estate investors, like a hard money lending company or a bank or institution of that nature, they are going to have a cost to the capital that they have on their books, right? So they may be paying, a bank might be paying depositors 5 or 6% on their deposits that they're sitting on, but they're going to be lending that money out at a rate of return that's going to need to be in excess of that cost of capital so that they can make the business worth their while. Same thing with hard money lenders. They're raising money from somewhere, whether it's a line of credit they have or it's other private capital they're raising, and they need to earn a higher rate of return of that. So in using private capital and raising private capital direct, basically talking to high net worth individuals or someone who just has $50,000 and saying, hey, I need financing for this property. It's a great deal. Would you be interested in lending in a first lien position on this property so I can fix it and flip it up? If something goes wrong, you can take the property back, and I'm the one that's going to be out the other side of the money that I put in. And in doing so, you basically circumvent the banks and the other hard money lenders out there. So you're able to raise capital at, a low price. A very common price point that people are raising private capital at right now is between 10% and 12%. Some people are raising it cheaper than that, but that's just a good rule of thumb to know kind of where the private capital raise is at right now. At the same time, when you're working directly with someone who has private capital that they'd be willing to lend to you on your property, you're going to have a lot of control over those terms, right? When you go to a bank or a hard money lender, they're going to tell you, hey, we lend out for months, we lend out for 18 months, we only lend out for 6 months. But with private capital, you can negotiate a term of 2 years. You can negotiate whatever they'll agree to and make sense for both parties involved. At the same time, you get to control, or you can negotiate when interest payments are made. Are interest payments made monthly? Are they made quarterly? Or are they just made when the loan's paid off at the end of the loan term or when the property is sold or refinanced? And that's a really big deal, especially for maintaining cash flow in a very capital intensive business like real estate investing. But the challenge, just like with banks you basically, as you raise private capital as a real estate investor, you're going to face a lot of the challenges that hard money lenders and banks face, which is how do we cultivate and manage these relationships where we are essentially stewards of capital? And we want to make sure that not only are we proactively, maintaining those relationships, but we're also sourcing new ones because, inevitably people need their money back and they need to do something with it. And it may not always be a perpetual, source of capital to get it from just one party. So raising private capital in of itself is its own business. And that moves on to the next point of where a lot of real estate investors get their capital from, which is hard money. And obviously, Chris and I know a lot about this subject, and I invite Chris to jump in at any point here. But hard money lending companies are private capital raised done for you. And I'll say that again. Hard money lending companies are private capital raisers that are raising money on behalf of you. That's the way to look at it. Hard money lenders have relationships with, they've already cultivated and developed those relationships with people who have capital, and they're raising money to fund your deals. So instead of real estate investors having to go out and raise capital for every deal, they can come back to a hard money lender who they know is going to have access to capital for them, ready to close whenever they need to close. And they can move quickly and systematically through the capital raising process, essentially the loan origination process. And I think that hard money lenders do offer something beneficial that perhaps doesn't always exist in the private capital space. When you're working with private capital investors, you are going to have to kind of set the system or the structure. If you go around and try to raise capital en masse for your real estate investment business directly from people, you're going to need to offer something consistent that you can repeatedly sell. Hard money lenders have already implemented that and done that. So that's how we have been able to raise capital, as we offer the same thing to capital investors. So they know what they're going to get, while at the same time, we know we can offer the same product to our real estate investors. So the system nature of hard money lending makes it so that our real estate investors who work with us can reliably go out and underwrite deals knowing what their cost of financing is going to be should they have to use us to finance their deals. And yes, does that mean they're probably going to have lower margin than going out and raising the private capital themselves? Absolutely. But I do think it leads to a lot of efficiency. And at the same time, while they kind of give up control over the terms, they're at least reliable. They can come back to and refer to every single time that they're going to try to close on a deal. So I kind of through the key subjects here in terms of the competitive advantages that are in the capital raise side. But really the world of capital raise is pretty infinite. You can finance your deals a number of ways. We see all sorts of creative deal structures being made, but I think one of the most common ones that we hear about are people that are using seller finance. Okay, we have the money to fund the purchase of this property. Well, probably the person that is you're willing to buy the property from, they have the exact dollar amount you need to finance the purchase price of that property. So we see all sorts of creative deals happening this way. In addition, we're not out here trying to exclude the bank financing or anything to that effect. I think those are more of the traditional methods of financing. But it's less common in the real estate investing space, right? Because most of the time, these conventional lenders aren't going to want to lend on distressed real estate. But all of the deals that you're going to be looking at and taking down as a real estate investor have some sort of value add component. The property is distressed in some way, shape, or form, and that likely isn't going to be acceptable by most conventional lenders, which is why hard money lenders like us exist in the first place. So I know I just covered a lot on the capital side there. We're obviously very passionate about helping real estate investors build wealth by using our capital. But I'll pass it back to Chris here and kind of let him add some points where I might have missed.
Yeah, I think that was great. And I think, I don't have a ton to add here. The one thing that I do think about a lot, because I have these conversations every single day, and I'm always hearing about what our competitors' terms are and about, what other people are offering and so on and so forth. And I really don't like to specifically try and sell somebody on one type of financing or one type of hard money lender or another. I kind of just want the reputation and the transparency and so on and so forth, like the effort that somebody puts in to make a deal happen. I want that stuff to speak for itself. I do think that there's an important difference here between a lot of different hard money lenders, depending on how they're structured, right? So for anybody who's not familiar, there's just different ways to structure a hard money lending company. There's a lot of the larger names that people see, like the Kiavis of the world or the Lima Ones, et cetera, where they're utilizing institutional capital. So, they're probably not holding their own loans. They're probably selling them off because that's basically how you scale this business to as large as they've become, right? You maybe use a warehouse line, and so you finance your deals with a line of credit, and then you go ahead and you sell the paper, you bundle it up, and you securitize it and you sell it off to, maybe it's hedge funds, maybe it's pension funds, whoever is investing in this stuff. Now, if you think about that, obviously, well, maybe not obviously, I don't want to assume anything, but when these institutional buyers are going to purchase these loans, they are going to have requirements, right? Because they're doing this at scale. They're buying hundreds of millions of paper at a time, hundreds of millions of dollars worth of paper at a time. So they have these guidelines and they have to fit a certain box. And so they can't really grow that large by customizing every single deal or analyzing every single deal down to a granular level. They just say, hey, does it check these boxes or does it not? And as a real estate investor, that could potentially be worth it if the deal that you have is cookie cutter and you want the cheaper terms and you have, 30 days to close and so on and so forth. And it could be great. We got a lot of clients who work with, both us and some institutional lenders as well. The difference in the way that we've structured our business is that we do have private capital. Grant mentioned that we're private capital raised for you. So we go out there and we lend out our own funds, we lend out friends and family funds, and we lend out our capital investors funds. And all of that money is still private capital, just like point number 2. It's coming from the same types of people that would be individual private lenders, but they're lending through us because we offer a vehicle with which they can deploy their money and they don't have to lift a finger, besides doing their underwriting or whatever they want to do. So we control the capital it's a long way of me saying we control the capital. It's still private money. We don't have these specific, we have our own underwriting, we have our own criteria, but we don't have these rigid boxes that institutions have. And we are the decision makers. We're the ones writing these loans. And so I'm pretty passionate about this because I've seen the institutional lenders reel people in with cheaper terms and make these big promises and then pull out the rug at the last second. Not all of them do that. It doesn't happen every single time, but I've seen it happen enough times that I've become very passionate about this. So I do think, it's important to note that even if you're working with a private lender or a hard money lender, whoever you're working with, beyond just a cash route, whether it's a bank or a credit union, not all of them are created equal. So spend your time, do your due diligence on who you're talking to and who you're about to do business with, and just do a little bit of digging to understand kind of how these business models work, because there's different business models that do exist. And I think there's different vendors, different capital providers that serve different purposes and different needs for real estate investors. And I think it's important that if you're going to grow your real estate investing business and you're going to rely on these partners, that you know which ones fit for which situation and the pros and cons of all of them.
Quick addition to what you're saying, Chris, for anyone who is trying to evaluate their hard money lender and wants to quickly assess whether or not they're a company like ours that holds the loans and services the loans on their own balance sheet, the quick question to ask always is, are you a balance sheet lender? Which essentially means when you originate a loan, when you originate my loan, is it on your company's balance sheet, or do you sell it to somebody else and do they have it on their balance sheet? And that will tell you a lot as to how much control they have when it comes to extending your loan or basically working out creative strategies to get your loan originated. Just a quick tidbit there for anyone. But other than that, I think we'll go to the next slide here, Chris. And yeah, I mean, we don't have to read directly off this slide here to know what's going on, but I think just some of the key points to highlight about the discussion we've had today is, I guess, well, really when we first got started real estate investing, I can remember telling myself all the time, there's no way this person's making money on this deal. They're way overpaying for this property. It doesn't make sense. And a lot of times I was looking at deals that were on market. So to this extent, maybe that was true. But really, all these points kind of came about when we got into the hard money lending game and we saw how these different investors were making money. And the question that really helped us start evaluating these different areas of competitive advantages, if someone were to buy a deal, we'd ask ourselves, how is this person making money on this? No way. Just right in play asking, okay, how is this person making money on this deal? And in doing that, you really start to think through all the ways that people are employing different competitive advantages to make deals make economic sense. So when looking at all the information or listening to all this information that we just kind of disclosed here, I think one of the things that we want to hint is, like, if you're going to start anywhere, the best place typically to start is the deal. Because if you have the deal, you can typically offer in pricing that essentially helps you arrive at a price point where you can perhaps employ general contractor to, you can use hard money or a more expensive cost of capital method to finance your deal. So if you're not strong in any particular area, I highly recommend starting with the deal. And I think Chris would recommend the same thing. And then I think really the ultimate goal, though, is to have strengths in every area of competitive advantage. That doesn't mean you have to have, your own construction crew or construction company and your own wholesale company and your own hard money lending company. Although that would be obviously very ideal, that's not the world that 99% of us live in. So just being strategic and employing some competitive advantage in all the areas across the board, I think will really help people make sense of more deals and find more profit in the deals they do.
Absolutely. And I think there's a way to jumpstart this, right? If you're just getting started, find people to partner with in each of these areas, right? Just go ahead. And I do think that if you have the deal, it's easier to partner with people, because if you have the deal, then you can find people who are interested in providing capital or doing construction or whatever it might be. But that's the best way to jumpstart it. I don't have anything else to add here. I think this is, hopefully you got some value from this one, because I know we talked through a lot of different stuff here. And this is really, besides management, which we didn't touch on in this video or in this podcast, these are really the primary pieces you need to put in place in order to have a successful real estate investing business. And we see people doing it every single day, and we're doing it ourselves with our own portfolio. So hopefully you got some value from this, but that is all we have for you today. If you enjoyed this video, if you found it helpful, then please share it with a friend, leave a review, and check us out at sharpercapital.com. And of course, if you have any questions, feel free to reach out to us at the contact info down below, and we'll see you in the next one.